Hey guys, Mike here. So obviously had an interesting day in the market Friday with, of course, people are still trying to pump it up. Warren Buffett obviously still selling Bank of America shares, celebrating his cash pile he's got going on. So we'll get into all your questions, everything, look at the futures chart and see exactly what happened compared to what we talked about on Thursday. But always remember, as Gordon Gekko says, and it definitely rings true for this market, that is for sure.
The point is, ladies and gentlemen, that greed, for lack of a better word, is good. Greed is right. Greed works.
At least that's what the market seems to be saying to us. It's pretty crazy. But when you look at what happened on Friday there, we talked about this level, right? This is where we started to sell down late Thursday. It's been a problem for the futures to get through this for a couple weeks now. So it was a good point to happen. And of course, we end up selling down as soon as we opened up, coming down. And when you look at where we actually started to reverse right after, actually during lunch, that is, you can see right there, going back over, it was a good spot because when we pull this up and look farther, it was at a spot where you had resistance now flipped into support, right? And so when we drag this out even further and go back, you can see it right here that this goes all the way back to August 27th, where it's been resistance. So now we get to see if this is actually true support. That's what it seems to be. And now heading back up into the other shaded area. Obviously, we'll see what they do Sunday when futures open back up, where they want to take this thing. And real quick, while I'm thinking about it, please hit that like and subscribe button. It helps push the video out and helps the channel. I sure appreciate your support on that. But, looking at your questions and stuff, one of them, and these are really good questions, by the way. Rivian Millionaire, he says, institutions will sell the market to get clients and the population to put their cash into stocks. The market needs a reason to get money out of the money market funds. There needs to be a dip to get more money into the market. What do you think about this tenfold theory? Well, it's actually not too bad of a tenfold theory when you look at it, and we can pull this up in TradingView and take a look. But when you're looking at money market accounts, they're broke down to two different ones here. So you have, obviously, the institutional and the retail. I can break down the retail for you, but then I got to combine both of them, okay, to show you these in TradingView. And when we, go over and look, you can see added up, it's really actually higher than this. This is 5.1 trillion, but this was, the latest I can get was September 19th. And so, and when we look at the total of this, you can see as of September 19th, about $5.1 trillion. So it is a boatload of money in there and stuff. And when we go to TradingView, we will pull up the total, and you can see right here that this is the total money market funds. And then we'll look at recessions, right? We'll look at dips and everything else. And you would think, hey, okay, when the market dips, these money market funds go down because what do? They end up taking it and putting it in the stock market and stuff. And to some degree, that is the case, right? To a little bit of a degree, but you don't see any major dips down, right? So let's pull up the SPY over this and see what we got, and we'll change this to a different color so you can actually see it. And so when the market actually really dips, of course, what happens here. And it's funny, you'll be able to see in retail, for example, how we are totally different than institutional investors, that is. And so when you look at this, you can see S&P starts to fall off a cliff. Money market, it's heading higher, right? You get a couple dips, blips, whatever you want to call them in there. Again, stock market's going up, money market funds are going up. And right there, you can see a dip with, and when I say dip, that's probably $100, $200 billion. Nothing to shake a stick at or anything total. But compared to the overall money market fund, not really. People think there's going to be like trillions of dollars flowing in the stock market. According to history, that's just not the case. And so you can see right here kind of the same deal when, stock market's going sky high, money market fund actually dips then, right? And so not so much of, we got to have this huge move down to get people to come in out of the money market funds. And we'll take even a bigger look at this when we look at other stuff. But when I pull up, we'll get rid of SPY, and then we'll go over here and let's look. And again, you can see what I'm talking about. That goes from 5.2 trillion, about 5 billion. So that's $200 billion, right there is about 2.5 billion, okay, or 250 billion, excuse me. And so, that's a decent amount of money, no doubt, depending on how much you're thinking is coming in. But then when we pull up retail, you can see retail does what retail always does, right? And you bring this up here of when it dips, and you can see it's coming down hard, and money market fund aren't really moving for retail, right? But when does money market really start to come down? It's when the market starts to go up a lot, right? That's what you notice. You see that we don't really buy on the major dip. We wait till it starts to go up and it's going way up, and then we that's when we put our money in. That's when you can kind of see it's going sky high, and all of a sudden the money market is dipping down like that. So you can tell the difference between retail once you take institutional money out of how we do it and stuff. Again, there's another one. It's going sky high. Not on the dip. We didn't bother doing it then. We went ahead and bought up on the rise up. Okay, which nothing wrong with doing that. I mean, as long as the rise continues, obviously. But no, it's pretty funny to see that and kind of convince ourselves that, oh yeah, I guess that's kind of what we do is overall. So again, people are expecting trillions. You won't get trillions, but there's definitely a chance you get hundreds of billions for sure. And really, that's all you need in a way when you think about it. So you combine that with the 401ks, the pension funds, everything else. So yeah, I do agree that should be the case somewhat, but not to the degree people think it's going to be. So great question. That kind of leads into this one, right? So Joe says, news people say there is still big money sitting on the side, which we just looked at, and not in the market because they are drawing 5% on their cash. Will these rate cuts affect big money on the side, drawing 5% interest? I guess will rate cuts affect the brokers and bankers guaranteeing 5% on the non-invested cash? Well, we're going to look at that, right? Let's just go ahead and pull our friend back up here, and we'll pull up the retail first in the money market, and then we'll pull up the Fed's fund rate over. Again, you get all this in TradingView, and you pull this up, and I'm going to change this so we can actually see the difference between the Fed funds rate and the money market funds. And we can clearly see that actually the Fed funds rate really doesn't affect what happens with our money market accounts, or you'll see it when I pull the total one up as well. But you see the Fed funds rate's going down. This one's going up. Fed funds rate's going down. Money market retail still going up, right? If we come over here to the right and try to go over every single one of them we've ever done, let me get this navigate on here correctly, and you can kind of see in 2019 we started cutting. And money market actually went up, not down. Again, over here, they paused. Money market still went up. And so that's retail. You go over the total, pretty much the exact same thing. And so there's really not a whole lot of difference here. So I really don't have a whole lot to do with the rates, because a lot of times when they're cutting, especially rich folks, what are they doing? They're like, oh, you know what? They think something bad's happening. We'll just keep our money parked safely. Okay, but the fact that retail is not even moving it, when you see the Fed funds compared to it, that's kind of interesting, right? Now, of course, this could be a first time that it happens or whatever, but, I think people seem, from what this chart tells me, get more cautious. And so I don't think it has to do with the Fed's funds rate as it does to do with the stock market going down and people being able to buy cheaper rates. So hopefully that helps. Dr. Mark says on this question, with the SPY averaging an annual return of 8 to 12% for the last 100 years or whatever, and us currently up roughly 19% year to date, actually 20% now, would logic dictate reversion back to the average by year's end? I know 2023 was a big year, and so was 2021. Could 15 to 20% be the new norm for SPY, or are we just in unprecedented times these past 4 years? And the truth is, I would just say we're in unprecedented times. Could be on my own on that one, but the reason why I say that is because remember, it's all about what?
Listen, man, I just need some liquidity, you know what I'm saying?
And so when you look over the last 4 years, what do you see? The Fed's balance sheet going from 3.5 trillion to a monstrous 9 trillion, still sitting at 7.4 trillion. What do you see going on with the government debt? Look at this, 2019 up. It just skyrocketed. 22 trillion up to 35 trillion dollars. You look before that, sure it was going up, but nowhere near as much, nowhere near as fast, right? And that's why people keep warning about the debt. It's the speed at which it's going up. And why is it going up so fast? Because for the last, looks like 6 years, we're running a $2 trillion deficit, which means we're spending $2 trillion more than we're bringing in. That's not a good thing. What else is happening with liquidity here? You had a $2 trillion infrastructure bill passed. So that's $2 trillion more just sitting there, and all this money hadn't even got into the economy yet. It's just kind of sitting there. Some of it has, some of it hadn't, right? Then you go over here, what do they start doing? According to them, over the last 4 years, they've forgiven $169 billion, or 4.76 million Americans, student loans. And by the way, if you got that done, put in the comments, congratulations to you. If I would have got it done for mine, I'd have been happy. Do I think it should have been done? Absolutely not. But hey, congratulations for you. I'm not a hater like that, okay? And so these last 4 years, you have just seen an unprecedented amount of money printing, QE, whatever you want to call it. And so, roosters, or however the saying goes, always come home to roost. Chickens come home to roost, whatever it is. Eventually, we'll maybe get, well, I don't know, maybe we will get back to normal at some point in time. I just don't know what it's going to take to actually get there. And so that's just my humble opinion on that. Now, when you look over here, you can see the next question here. And so let me know what you guys think in the comments about that one. Now, next question here is, thanks so much for demystifying the happenings of the market. What I would like to know is, every week people's paycheck has their 401k contribution pulled out and invested into the market. Does this happen on the same day for everyone? How much weekly, daily is automatically flowing into the markets when these 401k contributions get put into the market? And the truth is, there is no rhyme or reason to this. When I looked into everything, if you happen to know something, let me know. But remember, the reason why they don't all go in at the same time is because some people get paid weekly, bi-weekly, every 2 weeks, which is different than bi-weekly, or let's say twice a month, maybe different than bi-weekly, however it works, but they're definitely different because they fall on different dates. Get paid once a month. People like that out there, that's interesting, right? Really got to know how to budget your money on that one. And so, again, all of these contributions going into pensions and 401ks are hitting these firms at different times anyway. And, of course, you don't want it all going in on one day. That's not how they try to work it. And usually a lot of these orders, I'm pretty sure a lot of these orders, because some of them would have to be massive orders probably, but when you think about the overall stock market, it's just a drop in the bucket. But they're probably going, I'm curious to know if they would be going in under dark pool orders and getting broken up, or, you know, obviously coming public. I think they have to go in dark pool orders, what I would think. But again, there's no rhyme or reason to it. We know it's billions upon billions of dollars for sure, right? I mean, how many of you guys have a 401k? My wife has a 401k, right? I mean, you guys have pension funds you contribute to weekly, bi-weekly, monthly, all that stuff, right? So we know it's hundreds of billions of dollars, which keeps this whole thing afloat and everything. And so, but again, there's no one day, I don't know how you'd even go about finding the amount, to be honest. I'm sure I can Google something and just say, well, this is what we think it is, but that might not be the case. But it is one of the things that, you know, people keep wondering, well, how does the market just keep, why does it go up 70% of the time? Because you got a lot of people putting money in and they're giving it to the funds to do it for them. That's why the market goes up 70% of the time, right? That's where they make their money. But also, I was looking at something, I saw this video and it was talking about how I really hate 401ks. Pension funds, I don't mind as long as it's guaranteed. I don't like 401ks because of the hidden fees and the lack of control we have. But it was showing this chart of what percentage of stocks we used to own, like retail would be us, used to own versus what we own now. And it's going down from like 90% of actually individual stocks we owned. And then, of course, they came out with, you know, all these different kind of ETFs and things like this, like passive income, you know, vehicles and stuff for us, 401ks, right? And now it's going down all the way to like 40%, which is way down. It's more than half down, right? But also by doing that and us investing in ETFs and 401ks and pension funds, we gave up our rights to vote or tell the companies we own the stock and what to do. And we gave it up to the BlackRocks and the Vanguard, especially Vanguard because they're one of the most popular, BlackRock, you know, State Street, all these Fidelity, right? And they get to be the ones in charge of those companies and not us, right? Which is kind of dangerous. So you wonder why in the 80s, you didn't celebrate layoffs. In the 80s, the market would freak out if all of a sudden all these layoffs are coming down. And now you see when they announce layoffs, right? Verizon announced, Verizon, I'm pretty sure 5,000 employees, boom, stock goes up. Any companies announce layoffs and the stocks just roar. Well, who do you think's fighting for those layoffs? Who do you think's pressuring the board and the executives? It's BlackRock, it's Vanguard, it's all these ones who own so much of the stock, and we've helped them get it, right? Because it's our money they're using to buy the stock. It's kind of crazy, right, when you think about it, but that's just a side note. I had to get on a tangent by that one, but I saw it a couple of days ago, and I just wanted to share that with you. I mean, that's mind-boggling. So that's another way we've given up our power and stuff. So anyway, looking at the last question here, it says, how are ETFs, basically talking about SPY, QQQ, and a whole boatload of others, pricing? And it's usually two different ways. One is NAV, which you can read for yourself right beneath the first one, but the first one even says it, like everything else, supply and demand, right? If there's a huge amount of demand, like FOMOing, going into all these different ETFs, especially the Vanguard ETFs, which is probably the most popular, but SPY and QQQ, well, guess what? There's going to be a premium paid over what the NAV price is, right? Because supply and demand dictates, it is kind of like what you're willing to pay for it. And so that is how these are priced, okay? But you can see, just read it for yourself. The one right below that talking about NAV right there, that's how they come up with the value of these ETFs and stuff. So, you know, hopefully that one helps and stuff. But anyway, let me know what you guys think, what's going to happen the following week. Obviously, Sunday's video set everything up for you. It's going to be very interesting. I can promise you that one. I'll let you listen to something, you know, our guy Jim was talking about the flows and stuff and what he's expecting, and it might surprise you quite a bit. And he does a take on inflation, which might very well surprise you. So hopefully you'll get some out of that. But if you did get some out of this, please hit that like and subscribe button as usual, guys. I really appreciate you guys who watch and share the video. Feel free to sign up for the membership. Appreciate all you guys who do that and all your support. Let me know if anything I can do for you. And I want you guys to enjoy the rest of your weekend. Have a good one, guys.